What's up, guys? This week's video is on elective deferral contributions. We're going to talk about what an elective deferral contribution is, the different types of elective deferral contributions, how each type of elective deferral contribution will affect your paycheck, and also how you can figure out which one is best for you. All right, let's get started. All right, so first things first, what is an elective deferral contribution? An elective deferral contribution is essentially an amount that an employee withholds from their paycheck and deposits into a retirement account. That could be a 401k, a 403b, a 457, it could be an IRA. When you determine how much you're going to defer into these plans, you usually do it based on a percentage of your gross pay. Typically, when you contribute to these plans, unless it's an IRA for like 401ks, 403bs, and 457s, there's usually an employer contribution component, like a matching component. The amount that an employer is going to match is going to vary from plan to plan based on whatever rules they set up when they set up the plan. The other thing to consider is there are dollar limits that the IRS sets every year. So for 401ks, 403bs, and 457s, the limit for 2025 is 23,500. For IRAs, the limit is 7,000, and those limits are adjusted annually by the IRS. All right, so next thing is what are the different types of elective deferral contributions? So there's two types. There's traditional and there's ROTH. So a traditional contribution, also sometimes referred to as a pre-tax contribution, is basically a contribution that you make now that's not subject to federal income tax. So what happens when you make a traditional contribution is it gets withheld from your paycheck and that lowers your taxable income. So basically whatever you contribute that's a traditional contribution, that's you don't pay taxes on that now. You'll pay taxes on that money once it's dispersed from your retirement account later in life, once you retire. On the flip side, a Roth contribution is taxed now. So you would pay the federal income tax on whatever you're contributing now. And then once you disperse it from your retirement account later in life when you retire, you wouldn't have to pay taxes on those amounts. All right. So one of the main first questions you probably ask yourself is how does each one affect my paycheck, right? So in the example we're looking at here, um, this is basically what your paycheck could look like if you made about $60,000 a year and you were electing to defer 5% of your gross wages into a retirement plan. So if you look at the traditional column, you'll see that your contribution decreases your taxable wages. So you go from about $2,300 down to, just under $2,200 of taxable income. So if you have 20% federal income tax rate and then you have 15% for other taxes, what it all shakes out to is under a traditional contribution, your net paycheck would be $1,425. All right. Now, same amount of compensation, same amount of contribution, only we're going to do it as a Roth. So if you refer to the Roth column, you'll see that your taxable wages are equal to your gross wages of the 2307.69. Then down at the bottom, if you look at your federal income tax, you can see at 461, it's a little bit higher than what it was under traditional at 438, and that's because your taxable wages are higher. Um, Again, other taxes a little bit higher. And then your Roth contribution, the 115.38, it's still the same as what your traditional contribution amount was because it's based on the percentage of gross wages. Now, once you do the Roth contribution, what it all shakes out to is your paycheck is about $1,385. So your paycheck went down by about $40. And that's basically representative of the taxes that were paid on the $115 contribution that you elected to make. So um, basically, that's the gist of it. If you do a Roth contribution, you're going to pay more in taxes and your net paycheck is going to be less. If you do traditional, you're going to pay less in taxes and your paycheck's going to be a little bit higher. All right, guys, let's wrap this up. So, the last question is, how do you figure out whether you want to do a traditional or a Roth contribution? So, the idea is you want to pay the IRS as little as possible, right? So, what I if you go back to my video I released last week, what we spoke about is the US employs a progressive tax system, which basically means that as your income rises, the tax rate you pay increases. So the more money you make, the more taxes you have to pay. So when you're trying to think about, like, okay, do I want to do a traditional contribution or a Roth contribution? It really should be dictated on whether you're making more money now or in retirement, right? So for example, um, if you make less money now than what you anticipate making in retirement, you would do a Roth contribution, because if you're making less money now, you're in a lower tax bracket. So it makes sense to pay the taxes now on your contributions when you're in the lower bracket, so that when you pull it out in retirement in the higher tax bracket, it'll be tax free. You won't have to pay those taxes. And then, overall, you save yourself money. Now, on the flip side of that, if you're making more money now than what you anticipate making in retirement, you should do a traditional pre-tax contribution, and avoid paying the taxes now at the higher bracket. And then when you pull the money out and during retirement in the lower bracket, then you'll pay the taxes, and overall, it'll cost you less. Um, Now, the problem with that is you have to figure out how much money you're going to make in retirement, which isn't really straightforward. So, most of the time, people have at least two to three components of their retirement income. So, the first piece is going to be whatever distributions you anticipate getting from your employer sponsored retirement plan. So, your 401k, your 403b, your 457. Um, Basically, you can usually go online to your retirement account, and there's usually a tool on there where you can see, like, okay, if I contribute, X number of dollars a year for the X number of years, this is what I can anticipate my annual benefits to be from, this employer sponsored plan. So, you'll take that. And then the next thing that you got to figure out is about how much are you going to get from Social Security. So I left a link down below for you guys. The Social Security Administration actually offers a tool that you can use where you input your information into the website, and then it'll spit out an estimation of what your Social Security benefits could potentially be in retirement. So, you use that website. You'll have your you'll have your 401k, you'll have your Social Security benefits, and then you'll add in, whatever else you expect to get as far as investments, interest, dividends, rental income, etc. Once you have that full, amount of retirement income total, you'll compare that to how much money you're making now, and then, as we just spoke about and discussed, you'll figure out whether traditional or Roth is best for you, and then, you make your election accordingly. Um, Now, one last thing that we should touch on is, obviously this is going to change as time goes on, right? So typically, people that are younger, people that are earlier in their career, they're going to do Roth contributions because they're going to be in a lower tax bracket right now. um, as you move through your career and you move up and you start to make a little bit more money, once you go over the amount you anticipate making in retirement, you should switch over to traditional. So, by the time you get to retirement age, you should have a hybrid of traditional and Roth contributions. So, um, that's it. I appreciate your guys' time. Please like and subscribe, follow, all that good stuff. And, of course, if you guys have any questions, please reach out. My contact information is at the end of this video. Thanks, guys.